Momentum investing is an investment strategy that involves buying stocks or assets that have shown strong performance in the recent past. And its opposite is selling stocks or assets that have shown weak performance in the same period. This strategy is based on the idea that stocks that have recently outperformed the market are likely to continue to do so in the near future, while those that have underperformed are likely to continue to do so. Momentum investing relies on quantitative analysis of market trends and performance data to identify stocks or assets that exhibit strong momentum. It is often used as a short-term trading strategy, but can also be used as a long-term investment approach. Now let's know the key principles of momentum investing. The key principles of momentum investing include: the number one is focus on a recent performance. Momentum investing is based on the idea that stocks that have performed well in the recent past are likely to continue to do so in the near future. The strategy typically involves buying stocks that have shown strong performance over the last few months, and selling stocks that have shown weak performance over the same period. Number two is trends are important. Momentum investing relies on the identification of trends in stock prices and market performance. The strategy looks for stocks or assets that are exhibiting upward or downward momentum and seeks to capitalize on these trends. Number three is quantitative analysis. Momentum investing involves rigorous quantitative analysis of market trends and performance data. The strategy relies on statistical models and algorithms to identify high momentum stocks and assess the strength of trends. Number four is short-term focus. Momentum investing is typically used as a short-term trading strategy, with positions held for a few weeks or months. The strategy aims to capture short-term market trends and generate quick profits. And the last, number five, is risk management. Like any investment strategy, momentum investing involves risks. Successful momentum investing requires a disciplined approach to risk management, including the use of stop-loss orders and portfolio diversification to manage downside risk. Overall, the key principle of momentum investing is to identify and capitalize on trends in stock prices and market performance, with a focus on short-term trades and rigorous quantitative analysis. Now let's know the various types of momentum investing strategies that you can use to make good return on the stock markets. Strategy 1. Price momentum. This strategy involves buying stocks that have shown strong price performance over the recent past and selling stocks that have shown weak price performance. Price momentum can be based on short-term or long-term price trends. Strategy 2. Earnings momentum. This strategy involves buying stocks that have recently reported strong earnings results and selling stocks that have reported weak earnings results. Earnings momentum can be based on quarterly or annual earnings reports. Strategy 3. Fundamental momentum. This strategy involves buying stocks that have strong fundamental characteristics, such as high earnings growth, low debt-to-equity ratios, or high return on equity. Fundamental momentum can be based on long-term trends in company fundamentals. Strategy 4. Quantitative momentum. This strategy involves using quantitative models and algorithms to identify high momentum stocks based on a range of factors, including price, earnings, and fundamental data. Quantitative momentum strategies can be based on statistical analysis or machine learning algorithms. Strategy 5. Global momentum. This strategy involves investing in stocks or assets that exhibit strong momentum trends on a global scale. Global momentum strategies can be based on factors such as interest rate differentials, economic growth, or currency trends. Overall, momentum investing strategies can be based on a range of factors, including price, earnings, fundamentals, quantitative analysis, and global trends. The key is to identify stocks or assets that are exhibiting strong momentum and capitalize on these trends to generate positive returns. Now let's know how to identify high momentum stocks. Identifying high momentum stocks is a key aspect of momentum investing. Here are some common ways to identify high momentum stocks. Price momentum. Look for stocks that have shown strong price performance over the last few months. This can be done by looking at the stock's price chart and identifying trends in the price movement. Stocks that have been consistently trending upward or have recently broken through a resistance level may be considered high momentum stocks. Relative strength. This is a measure of a stock's performance relative to the overall market or its industry peers. Look for stocks that have a high relative strength score, which indicates that they have outperformed the market or their industry peers over the recent past. Moving averages. This is a technical indicator that measures the average price of a stock over a specific period of time. Look for stocks that are trading above their moving averages, which can indicate positive momentum. Volume. This is a measure of the number of shares of a stock that have been traded over a given period of time. Look for stocks that have high trading volume, which can indicate strong investor interest and positive momentum. Fundamental data. Look for stocks that have strong fundamental characteristics, such as high earnings growth, low debt-to-equity ratios, or high return on equity. These fundamental factors can help support a stock's momentum and future price growth. Overall, identifying high momentum stocks requires a combination of quantitative analysis, technical analysis, and fundamental analysis. The key is to look for stocks that are exhibiting positive momentum trends and have the potential for continued price growth in the near future. After knowing all the good things about momentum investing, let's know the pros and cons of momentum investing. Pros of momentum investing. There are several potential benefits of momentum investing, including outperformance. Studies have shown that momentum investing can generate higher returns than the overall market over time. This can provide investors with the potential for significant outperformance and higher returns. Diversification. Momentum investing can be used to diversify a portfolio, as it is a style that is not correlated with other investment styles. By adding a momentum investing strategy to a portfolio, investors can potentially reduce overall portfolio risk and improve returns. Clear entry and exit points. Momentum investing relies on clear signals to enter and exit positions. This can help investors make more disciplined trading decisions and potentially avoid emotional trading behavior. Quantitative analysis. Momentum investing involves rigorous quantitative analysis of market trends and performance data. This can help investors make more informed investment decisions based on objective data rather than subjective opinions or emotions. Flexibility. Momentum investing can be applied to a range of asset classes, including stocks, bonds, currencies, and commodities. This provides investors with flexibility in terms of the types of assets they can invest in and the markets they can trade. Overall, the potential benefits of momentum investing include the potential for higher returns, diversification benefits, clear entry and exit points, quantitative analysis, and flexibility. However, it's important to remember that, like any investment strategy, momentum investing involves risks and requires a disciplined approach to risk management. Now let's know the cons of momentum investing. Cons of momentum investing. There are also potential drawbacks or risks associated with momentum investing. Here are some of the key cons to consider. Volatility. Momentum investing can be a highly volatile strategy, as it involves investing in stocks that have recently experienced strong price movements. These stocks can be subject to significant price fluctuations and may be more vulnerable to market shocks or downturns. Short-term focus. Momentum investing is focused on short-term price trends and movements, which can result in frequent trading and higher transaction costs. This can eat into returns and potentially offset any gains from the strategy. Overconfidence bias. Investors who rely solely on momentum investing may become overconfident in their ability to predict short-term price movements. This can lead to a lack of diversification in their portfolio and an increased risk of losses. Reversal risk. Momentum investing relies on the assumption that trends will continue in the near future. However, there is always the risk that market conditions could change, causing the trend to reverse. This can result in significant losses for investors who are not able to react quickly. Behavioral biases. Investors may be subject to behavioral biases when using momentum investing, such as herd behavior, confirmation bias, and anchoring. These biases can cloud judgment and result in suboptimal investment decisions. Overall, momentum investing can be a high-risk, high-reward strategy that requires discipline, patience, and a sound understanding of market trends and conditions. Investors should carefully consider the potential risks and drawbacks before incorporating momentum investing into their portfolio. Momentum investing can be a valuable strategy for generating strong returns over the long term, but it requires discipline, research, and caution. Investors should carefully consider their investment goals, risk tolerance, and diversification strategy before incorporating momentum investing into their portfolio. Additionally, investors should stay up to date on market trends and developments, and be prepared to adjust their strategy as needed. As with any investment strategy, it's important to conduct thorough research and analysis before making investment decisions, and to seek the guidance of a financial advisor or investment professional if needed. In conclusion, momentum investing is a popular investment strategy that has been used by investors for many years. By focusing on buying high-performing stocks and selling low-performing stocks, momentum investing seeks to generate strong returns over the long term. While momentum investing can be a valuable strategy, it is not without risks and challenges. Investors must carefully research and analyze market trends, identify high momentum stocks, and manage risks associated with high volatility and behavioral biases. To incorporate momentum investing into your portfolio, it's important to have a clear investment strategy that takes into account your investment goals and risk tolerance. Additionally, it's important to diversify your portfolio and consider working with a financial advisor or investment professional. Overall, momentum investing can be a powerful tool for generating strong returns over the long term. With discipline, research, and caution, investors can use this strategy to build a successful investment portfolio. That's all for now. We hope you have liked this video. Don't forget to subscribe for more new videos. Please like, share, and comment below to give suggestions. For this channel,